What if the key to navigating your portfolio this week is preparation or panic? Tensions between Israel and Iran are escalating sharply, and the markets are already reacting. Today we'll explore exactly what's happening, how markets are behaving, and which sectors and assets are primed for both defense and opportunity. Welcome to the Investment Diary. No clickbait, just analysis and strategy. So, what exactly is happening between Israel and Iran right now? Since mid-June, Israel launched a massive airstrike Operation Rising Lion targeting over 100 military and nuclear facilities across Iran. These include critical sites like Natanz, Isfahan, and even locations near Tehran. In retaliation, Iran has responded with hundreds of missiles and over 1,000 drones aimed at Israeli cities. Civilian and military casualties have been reported. Meanwhile, the United States has entered the picture, backing Israel and launching coordinated strikes on Iran's nuclear infrastructure. The world is watching with bated breath, as fears mount that this could become a much broader regional conflict. But here's what's even more serious. Iran has begun to hint at potential threats to the Strait of Hormuz. This narrow waterway handles roughly 20 million barrels of oil a day, nearly 1/5 of global oil supply. Any disruption here could have global consequences for fuel prices and inflation. So how are financial markets reacting? Oil prices are spiking. Brent crude has jumped 7 to 11% since early June. We're seeing 5-month highs in the energy space. Safe haven assets like gold and the US dollar are also surging. Investors are clearly nervous. Global equities, including the S&P 500 and the Nasdaq, dropped sharply following the attacks. Bond yields are falling as investors pile into. US Treasuries analysts are warning that a prolonged conflict could drag the market down 20% or more. Oil could reach $130 a barrel, putting renewed pressure on inflation. This, in turn, could delay or even cancel any interest rate cuts the Federal Reserve had planned for this year. So where does that leave us as investors? First, this is a textbook risk-off environment. That means there are clear winners, and we're going to break them down right now. Let's start with energy and oil. This is the obvious sector to watch. Stocks like ExxonMobil and Occidental Petroleum benefit directly from rising oil prices. Exxon is a cash flow machine. Occidental is more volatile, but has higher upside. You can also look at USO, the oil ETF, for direct exposure to WTI. If the Strait of Hormuz is blocked, oil could spike even further, and these names will move quickly. Second, metals, specifically gold and silver. Tickers GLD and SLV. These are your go-to plays during global conflict. Gold is the classic. Silver moves with gold, but tends to have more volatility, so you can make more or lose more, depending on your entry. Next, defense and aerospace. Think Lockheed Martin, Raytheon, Northrop Grumman, and Aerovan. These companies benefit from increased defense spending and military contracts. When governments get nervous, budgets shift towards security. These stocks often run early in conflict cycles before spending bills are even passed. Let's not forget about bonds and currencies. US Treasuries are surging as investors flee equities. If you want to participate, look into TLT. It's the long-duration Treasury ETF, and the US dollar is strengthening. This is another classic risk-off signal. If you hold international equities, you may want to consider how a strong dollar could impact your returns. But the key question is, when does it make sense to rotate back into risk? You want to watch for 3 signs. First, any diplomatic breakthroughs. If Iran signals it's open to talks, expect gold and oil to pull back. Second, if shipping lanes in the Persian Gulf remain open and safe, that will take pressure off oil prices. Third, once markets stabilize, there's usually a bounce off, and quick, and sometimes sharp. That's when you rotate profits from defensive plays back into quality growth stocks. Let me walk you through a simple sample strategy. You could allocate 4% of your portfolio to GLD, 3% to SLV, 4% to Exxon and maybe 2% to Occidental for more upside. Add in 2% spread across the top defense contractors, and 4% into treasuries or dollar-exposed funds. Keep the rest in cash or core long-term holdings. Remember, this is tactical. You're not overhauling your portfolio. You're positioning for protection and short-term upside while the news cycle plays out. Now, some quick risk considerations. Oil might spike to $100 or more, but it's unlikely to stay elevated unless there's actual damage to global shipping routes. Also, despite the fear, markets often shake off regional conflicts fairly quickly. They drop hard, recover just as fast, and keep moving. This has happened before, and it could happen again. So keep your position sizes small, set clear, and above all, monitor the headlines. These trades can reverse in a heartbeat. Here's the bottom line. You're not betting on war. You're preparing for uncertainty. Geopolitical volatility is part of investing. What matters is knowing how to act, not react. The current conflict between Israel and Iran is serious, but with the right mindset and strategy, you can protect your portfolio and even find selective opportunities. If you found value in this breakdown, like and subscribe to the Investment Diary. No hype, no fear, just real-world investing for thoughtful people like you. Let me know in the comments. Which of these defensive assets do you feel most comfortable holding through the storm? Stay safe, stay sharp, and I'll see you in the next diary entry.